This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange. This is the first one we've held in a little while. I hope everyone had a pleasant summer holiday and is refreshed and ready to think about energy markets again. Today we've got the team here in London, but we are joined by our U.S. colleague, Mike McGlone. If you don't know Mike, he's joined us before. He's got a very interesting franchise. He's a commodity strategist for us here at Bloomberg Intelligence. We had him on around mid-May. The price for oil at the time was much closer to $110 a barrel for Brent. It even flirted almost with 120. Today we're back sub $90 a barrel. At the time when Mike was on last, he gave us a pretty bearish outlook. So Mike, here we are today. We're sub 90. Where do we go from here?
I don't want to annoy, but I think we're back close to a clearing price. I think is around 70. But typically, the way these things work is crude oil is famous for being a mean reverting commodity. The pendulum has swung, and it typically, after it gets too expensive, it typically gets too cheap. And I fully expect this whole thing is not going to be over until we go to near $50 a barrel. I'll talk WTI. I guess I have to focus on Brent because I'm speaking with the lead of the world in terms of what really matters for crude oil is now Brent, but because it's been kind of my history. So I stick with that. I think 100 is the ceiling now.
And how do you think about crude over a multi-year cycle? Is hundreds the upside in your view in the near term? But I think many people are already thinking about 2023, 2024. Certainly when you look at the oil majors or the E&Ps, they're not typically so focused on spot. They're looking out a little further. So, what's your crystal ball got in store when you look out over sort of a medium-term time horizon?
I've learned the lesson about the curve when it's in backwardation, and I believe it. When it's in contango, it just reflects storage. When backwardation, it typically works. So if you look out a year from now, I'm looking at these. So we got I try to focus on these 23.75. I fully expect, if you go further out, it's in the 60s, and I think it's going to get lower. So that's a key fact to remember is, and I think I want Will to bring this up later. The SPR has been significantly reduced, and that makes sense because of politics. But if you look at just the facts of what crude oil is, what kept me bearish is the paradigm shift in crude oil for the last 10 years was the U.S. going from a net energy importer to a massive exporter. And the only thing that stopped that was when prices went negative. People claim it, so now prices are back positive and all that's coming back at a slower pace. But what's not coming back is that demand, and I've showed that rolling over. So to me, we go back to that enduring phase. Now we have this war. What's the war doing? Look at 5-10 years from now. War is completely incentivizing the world to accelerate that process of getting away from fossil fuels, most notably from dicey forces, increase the efficiency, which has just been the case in the U.S. EVs are just getting started. And to me, the way I see crude oil is of all the commodities I look at, just don't see a lot of upside. I'm much more bullish in longer term things like copper and aluminum and the metals and platinum and palladium and gold, things that you can't grow. And even things like Bitcoin. But you look at crude oil, we're using less of it. The war taught us we don't want to use more of it, and we don't ever want to import it from places like Russia.
What do you think about dollar strength? Is it a factor in where we are today?
It's all a big problem. To me, that's part of the perfect storm right now for bearish commodities. The question I like to ask is, what stops dollar strength? Is it going to be the Fed? No, they're tightening. We have to have something very significant to stop that. And when you measure the dollar, it's versus what? A basket of current currencies? It's it's just, as Churchill says, like democracy. It's what's the better form of government? It's just the least worst currency on the planet. Maybe the Swissy beats it over time, but, show me their 11 aircraft carrier battle group. So it's against a basket. So I look at things like gold. Yeah, that'll beat the dollar over time. Bitcoin probably will. Crude oil, not really, particularly now that we have money supply contracting. And that's the key point that really kept me very bearish commodities is What really boosted all assets was the biggest pump in money supply in history up to the 2021 history, 2021 peak, and now that's collapsing. The Fed's making it collapse. What does that mean? Dollar strength. And the rest of the world's just trying to catch up to this problem with dollar strength. Some of us remember the Plaza Accord. I was a student in France in '85, and the franc went from, I think it was $7 to $8 to $5 because of that. And of course, we don't have that anymore. But to me, that is the big picture macro. And I wrote a piece years ago. If you're bullish commodities, blame the U.S. Dollar strength, massive producer and exporter of agriculture, increasing so in energy and LNG. And what changes that? This war just incentivized it, and it's just getting started. But it's also really the bigger factor is demand destruction. So I like to say, what changes the trajectory towards severe recession in Europe? You can tell me that. I don't know. What changes the same thing in China? I listened to Tom Orrick, our chief economist, and it fully solidifies what I've been expecting for years, is that somewhat of a Ponzi scheme is collapsing. They don't have that free market discourse. So I look at it on a global macro scale. We're heading to a global recession, means demand destruction. And the last time we did that, crude oil went from 145 to around 40, and that's WTI. I don't see why it's much different this time, except the high was lower. We can't get below negative like we did last time, but I think we're entering that enduring phase now where central banks are going to be reluctant to ease. Most in history, they can't ease anymore because they made the mistake, notably the Fed, of creating too much inflation, yet the world's tilting towards negative GDP. I'll end with this. A global economics GDP tracker from Bloomberg has turned negative, very similar to what it did at this point in 2008.
Okay, Salih, I want to bring you on to get a little bit of reaction from you. Mike's painted a pretty bearish picture. I think OPEC's got to be disappointed if they're listening. You know, they're trying to do the opposite. They are trying to manage prices, I think, perhaps above where we are today. So, you know, how do you think they're reading the situation, and what do you make of the sort of fundamental side of the equation?
Sure. So generally, I think longer term, we continue to agree with Mike's view. Looking at a shorter term view and with OPEC in mind, I think the last meeting that they had on Monday was an interesting one, not because they agreed to on that symbolic cut of 100,000 barrels per day, which is essentially just reversing that symbolic exact amount that they brought in response to the U.S. President Biden less than 2 months ago. But I think what they're essentially saying to the market is they're ready to cut more if they need to. And I think, I mean, I know Mike is seeing 100 as the ceiling now, but the way I read this OPEC meeting was that the group is really trying to put a floor to prices at around $90 a barrel. Again, I mean, we just saw Brent drop below $90 a barrel today, so it's going to be very interesting to see how they respond. The next meeting is on October 5, but they did say unless there's an emergency for which they need to get together again. So I think the dynamics is changing, and they're very much watching the market, and clearly they have been enjoying the high oil price environment, and they don't want prices to go much lower than where they are right now.
Will Hares, I want to bring you on. There's a lot of discussion over here in Europe about the sanction situation with Russia, but here in the UK, we've just got a new prime minister. We're talking about windfall taxes and these kinds of things. What can a European oil company do to take advantage of the current price environment? Are they investing more in new supply? Are they doing something else? Give us the lay of the land.
Yeah, thanks, Rob. So I think from a European energy company perspective, all this talk of, incentivizing, domestic supply as an answer to the current energy crisis that the region is facing is just fanciful. If you look at the UK as a oil and gas province, the sector is in decline. It's in terminal decline, and it has been for years. And so the prospect of getting more hydrocarbons out of the ground in the North Sea as a solution to this problem is just not, it's a non-starter for a number of reasons. A, there's not enough of it. B, the UK has just passed a 25% windfall tax on UK oil and gas production, which is a clear disincentive to explore and develop UK resources, and of course there's multiple sanctions that have been placed on Russia and the deadlines are coming up here. So I think that looking internally to solve this energy crisis belies a sort of pretty deep misunderstanding of the global oil and gas market, and instead we should be really looking at ways that we can ease demand, which I have yet to hear any politician in the UK yet bring up as far as a policy response to the crisis that we are facing.
Well, we do have a few questions that have come in via the chat. So anyone listening, feel free to type a question. We'll try to get to it. And the one that we've got here is, do you believe that the European Union would revert back to purchasing commodities from Russia in a post-war era? We'll get your view first.
Yeah, I think absolutely not. I think from a Western perspective, if you could wave a magic wand and Russian troops would all retreat back to Russian sovereign territory tomorrow, there would be no change in energy policy moving forward. You can clearly see what Germany is doing. Germany is the largest economy in Europe and by far the most exposed to Russian gas. They have declined their share of Russian gas in their mix from over 50% down to roughly 20% now, or even lower than that. And it's extremely clear based on policy response where the direction we are heading. And I think a reversal of that would be a massive geopolitical miscalculation, and also would give Russia a victory, and it would reward them for the actions that they've taken. So no. I do not think that the West will turn face and re-engage with Russia on an economic level until it has undergone regime change or has become a more sort of democratic, Western-oriented, liberally governed.
Salih, I want to come to you on this. Do you agree? And if Europe doesn't buy oil or gas from Russia, are we just shuffling the deck? With China, India, some other countries just pick up the slack, take the oil that Europe doesn't want to buy, or kind of how do you see it affecting the supply-demand balance if under this kind of scenario or condition we'll just laid out?
Yes, I mean, so far what we've seen through the barrels that Europe stopped buying from Russia, we've seen them reroute those via sea to other regions like Asia, especially India, which is a country that didn't used to buy a lot of Russian oil, but is a major importer now. Again, though, ahead of the European sanctions package that come into effect on December 5, Europe is still importing about 1.2 million barrels per day of oil from Russia, and how much of that Russia would be able to reroute as well, and how much of that India, China, and perhaps some other countries like Turkey would be able to absorb is not really clear to us. But I think it would be safe to assume that there would be more disruption to Russian flows and Russian exports. And the way we see the balance for the next few quarters, towards the end of the year and early next year, is still a market in deficit. So this is not going to help. Obviously, in our supply-demand balance, we have a few parameters that could just be changing by 1 million barrels per day or more. So it is a very difficult time to be making predictions. But we do see a market that's in deficit. And again, Iranian deal is something that's been talked about in the market a lot in the last few days, last few weeks. And there could be notable and significant amount of crude that could be brought back into the market that we see would be enough to flip the market into a surplus. But from what we've been hearing recently is that there are some obstacles that remain for an Iranian nuclear deal. So we really can't count on that. And the way we are running our core scenario right now is that we have Russian flows gradually going down and then going down a bit more after December. And in terms of Iran, we don't have any new barrels coming back into the market from Iran in our core scenario.
Okay, Mike, I want to get your reaction to some of this. You mentioned the idea of energy security, or you implied it, at least in your initial comments. What do you think we are literally sitting in the midst of a proper crisis, I believe it's fair to call it that, here in Europe right now. Is the U.S. going to do more to help send crude our way, and is the price high enough to really kind of help that, or do you see it kind of going in a different direction? Kind of what's the U.S. export situation going to look like as you read the tea leaves?
The chart I have in front of me right now shows U.S. net liquid fuel imports going negative 2 million barrels a day by the end of next year, which is 800 million barrels a year. And that's a trend I've been watching forever. And that does not include Canada. There's potentially a surplus of supply heading towards 20%. And it's just by free market capitalism. If you just don't even, the invisible hand of Adam Smith, and if you just follow supply and prices and squashing demand and supply that comes on because of profits, it's coming. It's coming more, and it's just a matter of time. Now, it's a question if U.S. messes it up or not. I think this is part of a prime time for some, Defense Production Act. The U.S. has an ocean of natural gas still underneath the state of New York, and it can't drill it because of local laws, and that's potentially changed. And we have a massive surplus. It's just the flip time, and I think today's the day where you see that. So, to me, it's a matter of time, but it's also happening. You've seen LNG leaving the whole world to go to Europe because Europe can afford it. I mean, Pakistan's got a problem. Asians got a problem because they can't pay the prices, and Europe's already kind of up to speed for their supply, and they'll be able to bring on that LNG during the winter despite Russia being cut off. But put yourself 5 years from now. This is a trend that's well ahead of ahead of the rest of the world in the U.S., and Europe's going to catch up now because they have to. It's a question how. I'm always a fan of increasing supply and let these things work it out. But it's just rapidly advancing technology. The key thing I wanted to bring out here is a lot of people have been discussing the release of the Strategic Petroleum Reserve, and it's just part of one of my bearish overall outlooks. When you have the party in power in this country of the largest energy producer in the world, and inflation's a problem, they need to get elected, they will do what they can to make prices go lower. And that's happening. We've seen that with the SPR. But if you look at the SPR, there's certain ways to look at it. I look at it as an inventory quasi, wannabe manager. It's very prudent to sell when prices are really high. In backwardation, you wave back in maybe a few of the futures. In backwardation, that the average average backwardation this year in the 1 year out was 15%. So I just did some quick back-of-the-hand math. The U.S. so far this year has sold 150 million barrels of crude oil out of the SPR. If they just replace that at 15% discount in the further out futures, which they can take deliver on, they save $2.2 billion, and they keep inventories where they are. But the key point I'll end with is, SPR is now a redundant thing in this country. You don't need it anymore because U.S. is now a net, including Canada, a net massive exporter and producer of liquid fuels. I have to include ethanol and biofuels. I spent my weekend in the Midwest last weekend, and it's just amazing what they're doing with the land. You see wind turbines, corn underneath, and 40% of that corn goes to ethanol, and farmers are finally making money. It's not going to last much longer because they're going to bring on more supply.
Okay, Patricio, I want to come to you now. Okay, so Mike just laid out sort of interesting theory about the idea that U.S. policymakers want to do everything they can to manage energy costs. I think European policymakers are also in a similar conundrum. they're probably more focused on gas than oil per se. But what do you make of the state of the gas market and the EU's proposal for capping power prices and some of the other things they're trying to do to help manage the inflation and the cost to consumers?
Sure. I think I'd echo what's part of what Mike said, and Will also pointed out. I think all the regulatory measures, whilst they haven't been confirmed, will focus on demand reduction, because this obviously will alleviate the burden, the fiscal burden on the governments to actually pay for the mounting gas bills. In terms of pricing, I also agree with Mike in terms of supply for the winter seems robust, built on a really well-built, stocked-up storage inventory that's set to be around 90% full by November, despite Russia cutting off supplies via Nord Stream 1, which is the biggest pipeline into Europe. That assumes that flows via two existing lines via Ukraine and Turkey continue to flow, but it has reduced let's say the shortage risks significantly. The big storage build that we have. So yes, it looks like we can weather normal winter, meaning that we have normal weather temperatures and not a very prolonged heating season. But it will come at a cost. It will be still at elevated prices, perhaps not as we're less likely to see those spikes that we recently saw beyond those 300 euros per megawatt. But we are still at a level of 230 euros per megawatt, which is still almost 10 times the 5-year average. So yes, we can survive winter, it looks like, but it will come at a cost. In terms of the regulatory intervention, I think that will be announced by the end of this week, and it's been proposed, or it has been reported, that it may include a price cap on power generation from infra-marginal technologies, meaning anything that is not gas at this stage, because gas prices are setting the price for all of the wholesale electricity prices. So delinking those prices via a price cap at 200 euros. May I say that appears generous, given a levelized cost of electricity from renewables is much lower, from nuclear is much lower, from hydro as well is much lower. So this price cap appears generous, and it omens, I think, a good outcome if it's applied, given it would not stifle investment in renewables, and it would still incentivize lower cost electricity production. But again, it's still uncertain, so we wouldn't be overly optimistic about that cap yet. We still see a risk of windfall taxes on electricity generators, with unhedged producers most exposed. But may I say, most European utilities are largely hedged forward. So we see very relatively limited risk in terms of windfall tax.
Yes, the levelized cost of electricity for solar is in range of 50 euros a megawatt hour. Solar plus storage is in range of just over 100 euros a megawatt hour. So, the headroom you've got if you're doing wind or solar projects or even nuclear today is very substantial, based on spot power prices. And so there has been some interesting news around kind of what's going on with the supply mix there. Germany appears like it's finally capitulating and has some interest in keeping its few remaining nuclear power plants on just a little bit longer. And in California as well, there was just a vote just recently here to extend the life of Diablo Canyon. What do you make of something that's like nuclear in response to the current energy crisis? Are we going to see more? Are we going to see extensions, even new build?
So we're unlikely to see any meaningful new build in the near term, even if we did. Building a new nuclear power plant takes about a decade, really, if things run smoothly, and they also tend to run over budget. But we do expect we could see a few extensions, but with the caveat that, for example, Germany has has placed, let's say, a loophole in their extension, leaving only 2 out of their 3 remaining nuclear plants sort of on standby in case of emergency. So these plants are not currently they're not going to be running after December, but they'll be stacked just in case of emergencies. We've seen a new nuclear reactor on stream or set in operation this year in Finland, but we don't expect any new builds in the near term. But we do highlight, of course, that the UK and France's energy security plans moving forward do have a significant component of nuclear in their mix. And it's also important to note, I think it's really important to highlight EDF has pledged to increase its plant availability to 100% by December from 43% now, which seems a very lofty target, but in any incremental progress in increasing the historically low plant availability we have at the moment would definitely help plug the gap or that dependence on Russian gas or in gas in general, really.
Mike, I want to come back over to you to get some perspective from the U.S. kind of along these same lines. We've got the Inflation Reduction Act, which provides tremendous incentives for wind, solar, hydrogen, electric vehicles down the line. What's the feedback loop into commodities from that, in your view? And do you think the act is well named? Is it actually going to help reduce inflation?
I'm always skeptical of things like these from politicians, but this one was basically what we had predicted, and it's just following human nature. And that is, at least we have incentive to not cut back on fossil fuels, to increase all the above. And this is basically like a war production act. And that's what I thought was good about it, because this will do what it's supposed to, increase the supply. Don't throw money at it. Don't throw money at people so they can buy more fuel, which we're doing in some places like in California. That's not going to help, and it's going to just help politicians get reelected. But in the big picture, I think it's just going to accelerate existing macroeconomic trends that are overwhelming now. These are a paradigm shift in global energy. Why has the world's largest energy consumer of 10 years ago shifted lower in energy consumption, yet still with massively increasing GDP? Now, not lately, but the last 10 years. It's just simply in efficiency, yet production of energy. It's the human condition of harnessing energy is off the charts. Yes, we had a little blip, but it's coming back, and it's just different forms of energy. I look at that as someone who has an electric car, 2 electric bikes, solar panels, and powered my home with mostly renewable sources. I tested it, and it works. And that's right now incentives. It's just happening now. It's accelerating that process, and that's what I think is I find good about. That's why I've been really impressed with your team is you're focusing on that new energy area. I've seen a lot of your reports lately. I'm like, yes, that's where it is. That's where the profits are. Fossil fuels are great. Don't limit them, but just by incentivizing the new ones will help push back. That's a mistake that people like that they made in Germany and pushing back in some of the old forms of energy too fast. But the storage of, you mentioned, of electricity in terms of solar, it's coming fast. And I think we're going to look back at this period 5 years from now as the paradigm shift that shifted us over into the new world. Yet these two countries, led by autocratic leaders, are pushing back into the old world.
Will Hares, I want to come back to you pretty quickly here. You helped lead a note with our analyst, Sonia, on the Inflation Reduction Act, and you looked at it across a wide spectrum of industries, but I know from your own franchise, you took a look at what the new legislation could mean for European oil majors. Do you agree with Mike? Is this really a paradigm shift?
Well, I think, to be clear, most of these investments from the European energy majors were arguably going to happen regardless or certainly were pre-planned prior to the energy crisis and Russia's war in Ukraine. So I do think that the energy transition it was accelerating before this, and I think this probably is just going to push that even further and quicker. And I think the U.S. Inflation Reduction Act is a great example and catalyst of this, where we're seeing $369 billion of that legislation being dedicated to climate change and bolstering low carbon energy and infrastructure. And I've highlighted that while this is is U.S. legislation, European companies, in particular the energy majors, and of course some of the utilities that Pat covers, will be clear beneficiaries of this as well. They are already investing heavily in the U.S. as a clean energy jurisdiction. All of the European energy majors have major footprints, whether it's in wind or solar. We're seeing offshore New York, New Jersey, Massachusetts as an emerging offshore wind giant of a jurisdiction, and we've seen some major offshore auctions there, and so Shell, BP, Equinor have all been heavily involved in this, and opening it up to or bringing in this new funding and legislation is only going to serve to bolster that, and I think will attract more investment and more companies as the U.S. accelerates its energy transition along with Europe.
It's fascinating to see. I recall when I was living in Boston 15, 20 years ago, the opposition to Cape Wind at the time was just profound, and the idea that we're going to have a major offshore wind corridor there in the Northeast is very interesting. Let's see how it plays out. So we are running up on time, but let's just do a quick round robin. Mike, we're going to come to you last, but Salih, we'll start with you. As we head into 4Q and towards the end of the year, tea leaves from you. How do you read the oil market? Bullish, bearish, supply, oversupplied, undersupplied into year end?
I mean, as I mentioned earlier, we do see an undersupplied market, and we understand that there has been a lot of concerns around demand, which we've been arguing is the final remaining lever to be rebalancing the market, and that's what we're seeing. We think the market is expecting a big recession, a huge impact on oil demand. But on the supply side, the fundamental risks that we've been highlighting for months remain. I mean, when we have demand coming back from China especially, which would be more than 1 million barrels per day, when we have more flights going around, which would mean more jet fuel demand, we just don't see a lot of supply that will be able to match that demand. I mean, we thought that would happen this year, but I think we're just extending when the market will have to reckon with that. So looking towards the end of the year, I think demand worries will probably remain, but we are still aware of the fundamental risks, especially on the supply side, and we will be watching where OPEC supply is, where OPEC production is, which, by the way, is about 3 million barrels per day behind its targets. So again, still relatively bullish. Our forecast outlook is relatively bullish, especially from the current levels with Brent now below $90 a barrel.
Well, Hares, I know you and Salih are pretty copacetic, well aligned on this stuff, but any divergence as we head into 4Q in the year end?
Yeah, I continue to think that there's a lot of upside still to come into year end. After the SPR stops 1 million barrels a day in early October, we have the Saudis threatening production cuts. We've got the European sanctions on all seaborne Russian crude on December 5th, and we have the European sanctions on all Russian seaborne products on February 5th. And so I think on the supply side, there's a lot of bullish flags here, and with the caveat that China can get a handle on its COVID flare-ups in different regions and recurrent lockdowns, and that demand doesn't take a massive hit from potential recession risk. There are some pretty bullish signals here on the supply side.
All right. So, Mike, we're going to give you the last word on oil. Patricio, sorry, I'm assuming you don't want to weigh in on oil, but we'll give Mike the last word here. I think you see it a little bit differently, but Mike, same question to you. Where do we end the year at?
And WTI maybe a little bit higher, and Brent maybe lower. I'm afraid it's going to be lower because I think we're tilting over to similar to 2008 scenario. It's actually worse. I don't see China coming back. In fact, we've been predicting this from years. Bloomberg Economics has been predicting it, so there's a demand source that's probably not going to come back. U.S. and Canada net massive exporter because of one key thing. High prices are incentivizing more production and disincentivizing demand. We're heading towards a global recession. Particularly in Europe, I mean, basically you've had the plague, then you've had an energy crisis, you have a war, which accelerated energy crisis, and the drought. I mean, yeah, that's pretty bad. I don't know if it gets better. So to me, this is new 2008, second half, getting worse. And the key question I ask myself is what changes these scenarios versus accelerates? It's not going to be the Fed. They're raising rates more. And I think most commodities are going to follow copper and lumber, which are down 20% and 50% on a year.
All right, we're going to have that be the last word, but just a couple of quick things. Look, everything we've been talking about here today, you can find on the terminal on BI Go. We've got a commodities dashboard. That's BICOMDG Global. Mike manages that dashboard, but you can find primers on all of the commodities that we discussed here today, and to read the reports, look at the technical analysis. It's all there, and I encourage you to look at some of that. If you have got follow-up questions, we're always also happy to chat over IB or even answer the phone if you've got a question, so reach out. And then just a bit of an advertisement coming up of 2 weeks from this Friday, September 23rd. For anyone who's here in London, we've got a roundtable lunch where we're going to be talking about oil and the energy transition. We're going to be joined by Jason Gableman from Cowen. Will Hares and I will also be there. So register for that. You can find the event on SEMR or just reach out if you need more information on how to join us. So always a pleasure. We'll hold the next one of these on Wednesday, September 21st, and look forward to talking to you then. Thanks for your time, and I hope everyone has a great remainder of their week. Thanks for joining, Mike.
Thanks for having me.